Let me introduce our guest here, Harvard economics professor Ken Rogoff, frequent guest on Squawk Box, former IMF chief economist. Thanks for joining us, Ken.
Hey, thanks for having me.
So I'm going to make an observation since I've been here for a couple decades. I don't remember a time when the bond market was so important to what was the discussion on monetary policy here at Jackson Hole. It feels a little bit like we're having a backyard suburban barbecue and a motorcycle gang showed up. Huh. And it's really influential. When you look at what's happening now, some people say it's just a temporary blip. What's your thoughts on the higher yields right now that the U.S. is experiencing?
Well, as you know, I've been writing about this for 15 years, that if you look at the history of interest rates, they're low sometimes until they're not. And this is something we always should have expected. But there's been an overwhelming thrust at this conference, because it reflects academics, of low forever. That I think there was even a paper last year about how they're going to get the real interest rates going to go down and down. And that's, of course, very important to the central bankers, because they're seeking an interest rate that will have, neutral inflation implications. Where is it? And they'd like to believe it's a science, but, in fact, it's very hard to predict.
Let's take it apart a little bit, because we all know there's different components to the interest rate. There's an inflation component, there's a growth component, there's a term premium component. Some people say, hey, this is just reflecting, or there's a supply and demand component, of course. Some people say this is just reflecting higher growth expectations.
Yeah, some of it. I mean, certainly the AI build-out's big, but it's also the Iran war, populism around the world. I mean, it's not just what the United States is doing, it's what everyone's doing. But the honest truth is that if you look at trying to explain the inflation expectations adjusted interest rate, the real interest rate, it's very hard to explain. And they've had papers here explaining where it's going to be 100 years from now. We can't explain why it moved the last 100 years. I mean, an example is people say aging means the interest rate's going to go to zero. There have been many papers on this here. But if you look historically, that doesn't work.
When you think about what's happening right now, how much is this supply-demand issue? It really didn't seem like it was, the yields were really that much higher until it became clear how much the AI companies were borrowing, and it was a debt story, not an equity story.
No, I mean, interest rates, real interest rates had risen dramatically a few years ago at this point. Like, they were actually at a little bit higher levels at one point. They're slightly below the peak. So it's many things. Yes, it's AI. Yes, AI is amazing, but you've talked about it a lot here, but it's not all growth. And if it turns out to be growth, the interest rates will go up even more.
What's your reaction to what the Treasury announced last week? Part one was when they said they were going to increase the buybacks. Part two is our reporting that they might use the TGA to do so.
Yeah, well, look, I mean, there's this discussion that is he stealing something from the Fed? Is the Treasury encroaching on the Fed's territory? And I think the fact is, if you go back after the financial crisis, it was the Fed encroaching on the Treasury's territory. Maturity transformation, how much of your debt is long, how much it is short, is fundamentally a Treasury decision. What risk do we want to take? And people don't all understand the Treasury owns the Fed, lock, stock, and barrel. So it's like, you have your son making the decision for the family of what you're going to be borrowing. So there's a transition. The thing that Besant fumbled is he did it as if he was making the bond market go down because he's doing that and magically making a change. And he said it in the context of interest rates were going up. So that was botched. But I think the principle is fine. And I think Kevin Warsh, if you go back to his speech at the IMF a little over a year ago, he's fine with that, of having the Treasury take over the longer-term trajectory and the Fed do the firefighting.
I was going to say, it sounds like you agree with Kevin Warsh about the Fed stepping back and letting the Treasury take the lead on this issue of debt management, duration, all that stuff. It sounds like you would support a smaller balance sheet at the Fed.
Absolutely. I completely agree with Kevin Warsh on this. I mean, you have to change the regulations. People say, well, the banks want all the Federal Reserve debt. That's because regulations were passed that made them want it. It's a little more liquid. You can trade the Fed debt, any 24/7. But the amount they have, they don't need that kind of liquidity. But it's not something you can do overnight. And again, Bessent fumbled it a little bit here. I mean, and of course, we'll see if Warsh says something about that, not about Bessent fumbling it.
Right.
I wouldn't be surprised if Warsh reprises what he said at the IMF a year ago about mission creep, let's get back to our knitting.
Let's go sort of more on the higher level here. How much should people really be worried about things like the U.S. debt right now being at, what, it's 6 or 7% of GDP in peacetime?
The deficit.
The deficit, sorry. And how at risk is the dollar as a reserve currency, in your opinion?
Well, I mean, long run, China's going to get a bigger share of the market than the euro is because we impose sanctions all the time, and they want Europeans are worried about Greenland and Iceland and China, Taiwan. But, you know, the biggest threat over, say, the next 5 to 10 years is from the inside, that we just aren't prepared to balance our budget. We're rich. We were always rich. We could afford to. I have theorized and said in my book, Our Dollar, Your Problem, and many writings, we're going to have a crisis because the voters won't allow anything else. They won't believe you. You can't get elected. So I think we will have some kind of debt crisis, financial repression, inflation, maybe something more dramatic. We might not be the only ones, the UK, France, Belgium. But yeah, I think it's coming, not because it has to happen, but that's true about every debt crisis. Argentina, when they defaulted when I was at the IMF in 2001, the Argentine citizens had more money abroad than the Argentine government owed.